Hey everybody, Josh Sigurdson, World Alternative Media here, and of course we're joined by author and economic analyst here at WAM, John Sneisen, and we have been talking about the Australian housing market for many years now, and it just continues to, well, develop. It's getting worse and worse in many of the major metropolises in Australia. We are seeing as much as an annual 10% drop in value, 10.9% for in some cases, as far as 14% in some places. Anyway, I'm going to go into this article from news.com.au, which says house prices notch worst annual fall since GFC. And as the article goes into, Australian house prices have notched their biggest annual fall since the aftermath of the global financial crisis. House prices in Sydney and Melbourne fell 0.7% and 0.6% in April. CoreLogic figures released on Wednesday show bringing their annual declines to 10.9% and 10% respectively. The NSW and Victorian capitals are now 14.5% and 10.9% down from their respective peaks in July and November 2017, extending their falls further into uncharted territory. Sydney's previous worst decline since the firm began collecting data 4 decades ago was 9.6% between 1989 and 1991, while Melbourne's worst decline was 10% between 1989 and 1992. Sydney definitely has been in record territory for some time. Melbourne hit its record decline last month, and we see falls continuing, said CoreLogic head of research Cameron Cusher. And I quote, "The main thing to take out is obviously values are still declining at a national level, but the rate of decline has slowed for the 4th consecutive month. So while that's maybe encouraging, more regions are seeing declines," end quote. Nationally, prices fell 0.5% over the month to a median of 519,879 Australian dollars. That brought the national annual decline to 7.2% and the total decline since peaking in September 2017 to 7.9%. At 7.2%, it's the largest annual fall since the 12-month ending February 2009 in the wake of the Great Financial Crisis, slightly behind the 7.4% annual decline notched in January of that year. The combined capitals fell 0.5% to a median of 593,401 Australian dollars. Every capital city recorded house price falls except Canberra, which notched a 0.4% increase to a median value of 596,405. Sydney fell 0.7% to 780,672. Melbourne 0.6% to 621,759. Brisbane 0.4% to 484,047. Adelaide 0.1% to 430,352. Perth 0.4% to 440,546, Hobart 0.9% to 452,302, and Darwin 1.2% to 390,621. It comes a day after Reserve Bank data showed weak lending conditions continued in March, with credit for mortgages increasing by 0.2%, slightly lower than the previous month. Annual growth in investor housing credit was the lowest on record at 0.7%. Credit conditions are still tight, but they've maybe eased off a bit, Mr. Cusher said. We're seeing some borrowers offered lower interest rates. Funding costs have come down, but even if we were to get an interest rate cut, most lenders are still assessing borrowing capacity on a rate above 7%. That means while some people might get a bit more money in their pocket if there is a cut, it's not necessarily going to drag a lot more buyers into the market, he added. The RBA is increasingly expected to cut the cash rate even further from its record low of 1.5% when the board meets next Tuesday. CoreLogic maintains its overall forecast of a total peak to trough declines in Sydney and Melbourne of 18 to 20%. So what do you think, John? This is getting so out of control. I mean, well, actually, I think the biggest problem was in the first place, it was heavily in control. It was heavily manipulated and controlled. And, you know, people made a lot of money for a while. We saw massive rallies, but it met its inevitable end, as we've been talking about and warning about for many, many years in Australia, as if the Australians don't have enough issues to have to deal with. So what do you think, John?
Well, I think Australia has had this problem for a very long time, and it's of course who caused all of this. It's the Royal Bank of Australia, the central bank over there, which dropped the interest rates severely. They were around 7 point something percent during the global financial crisis, the GFC, as was mentioned in the article, and now they're at 1.5. People are struggling at 1.5. Back in the day when our parents, the baby boomers, took out their loans, they had 16% and were struggling. Well, now we're struggling at 1.5%. So it just shows you how bad of a bubble we created. And it's not just real estate bubble. Like, this is the money bubble that we got to understand that this is, and debt bubble that comes with money, because money is debt. And what we've been seeing in Australia is, of course, one of the three probably big bubbles out there, which is, of course, also the Canadian housing market with Vancouver and Toronto that are dropping massively right now. And then also in the UK, it's starting to really hurt as well.
But we can't forget China.
Well, yeah, China is just insane, where people, most people, like, there's so many people owning just 3 houses now because of this real estate boom that they had here, and investor boom or whatever. But what we got to understand is that this is just a created crisis by the central banks, by printing too much money, by lending it to people that can't afford it. But when you take a look at who's getting really hit here is the newer developments. For example, I was listening to a video just that I posted today on Facebook, and in that video they were talking about people having to pay up as much as 110,000 Australian dollars on what they thought that they would actually get a mortgage for on just the land in Melbourne, in certain suburbs that are just getting built. And this is
Melbourne, get it right.
Melbourne.
Melbourne.
But this is the problem, Josh, that we're seeing real estate usually gets hit at the most the highest valued real estate, because they have the highest overvaluation usually. You won't see it so much in the lower valued parts of the market, of course, but where you're going to see it severely is in the suburbs, which is the middle class that are living there, the people that are driving the economy by going into debt on a worldwide scale. These are the people that are getting hurt. The new homes, of course, have quite the substantial markup on top of that that they charge, and of course just the real estate value of $400,000 is pretty insane. Now it's of course dropped down quite a bit, but you're looking at like the prices that they have to pay and the shortfall now that they're in the negative. All these people that have not like, these guys haven't even built houses yet, but then of course comes the people that have built the houses just recently and now have seen the pricing drops.
Well, imagine the insane rate of speculation involved there in something that is not promising at all, and most investors will look at that and say, run away as fast as you can.
Oh, of course. This is the problem, is that, people go in and speculate, just go and buy houses. But the problem is they're not educated on how to do it, how real estate investments work, because it takes a lot of time to understand that and fully become a professional, good real estate individual. I know several.
Yeah, but it's easier to roll some dice, John, and watch an HGTV show or something and see some guy flip a house really quickly, and then they clip to after they're finished, and it's like, oh, they made some money. It's like snap your fingers and make it happen. When it's excruciatingly difficult, it's fun. Most real estate investors I know have a lot of fun. I think it would probably be a lot of fun to get involved in. But with that said, and it is profitable, but with that said, it's incredibly risky, and you need to understand understand the market, and so many people get into it like it's a game instead of actually understanding how that market works.
Well, yeah, they built a system, right? They have created a system that made them really successful, and that they're able to do flips quite, fast. But the thing is, it's not about those. It's all about the people that don't know what money is, don't understand that your house is not an asset when you buy it. Your house is not an ATM. Look at the head of the CMHC just came out. Me and Tim Pachot did a video talking about how the head of the CMHC came out and warned the Canadians not to use their house as an ATM. It just, when the government comes out and warns about stuff, that's when they know it's getting pretty late in
well, and at this point, even for the renters, John, I mean, people who are going around renting houses, they have to be reassured now when they go to rent the house that it is not prone to being foreclosed on. That these houses won't be foreclosed on because it's paid in full. Everything's going to be okay. And it says a lot about the market when, landlords have to be assuring every single person that goes to rent a house, don't worry, when the inevitable crisis comes, you won't be pushed out onto the streets like so many did back in 2007, 2008.
Well, this is the thing is, when we all have overindulged in debt without understanding the consequences of it, and that's of course the bankers won't tell you that. And in Canada, they're 48% of the population is just $200 away from insolvency. You know that there's a severe problem, and this is the same in Australia. I took a look at, you should all look up a report that I did that I have for sale on my webpage, theeconomictruth.org, on the Australian economy, where I went actually in great detail on to the Australian economy, took a look what's happening there, and I saw some severe problems. Of course, it's the mass amounts of debt, it's the real estate bubble, the overindulgence in debt in several big markets around in Australia, and then on top of that you had a lot of issues with where actually the Royal Bank of Australia is selling their gold currently, which they have a ton more than Canada, which is nothing, but they're selling their gold. You have, I looked up the insurance for people to have their money in the bank. It's ridiculous. Like they basically give any failing bank $20 billion, and then that's out of the NAB and other major banks in Australia. They have over usually between 650 to 900 billion dollars of the deposits on their account. So that 20 billion is not going to go very long to insure through the financial claims scheme, as they call their form of CDIC or FDIC. The Australians are in very big trouble here, and you're seeing it because of the banks and the government has put together a scheme to try to prop up the markets, because they know that the people think that their house is an asset. So they people think that they're getting rich because their house is going up in value. Meanwhile, it's actually just a whole bunch of money floating into the market, which makes the inflation of the price just substantially. It has nothing to do with the real underlying value of your house. Your house is mostly depreciating in value because it deteriorates over time. Of course, it's not like an asset that would get nicer and better over time unless you actually do renovations.
Yeah, unless you fix it up and do what you can to make it better, make it more valuable. But I have to mention, John, I mean, with all of this said, and you mentioned the banks and the banks being heavily bankrupt if you consider their cash to deposit ratio, which you've gone into before, but also this all adds up to the major global debt bubble, like the massive amounts of debt that we see around the world just flowing and getting more and more volatile. And again, how that benefits the bankers, how that benefits the governments, and how it hurts the populace vastly. Looking at any regular individual, the government and the banks benefit off of the indebtedness of the populace. It means that they have more control over people because people get more desperate. In fear, they beg the government and the banks for more help in this way or that way, and it puts them in more and more debt, and it just piles up. And the debt bubble worldwide, from individuals' household debt and from there to the debts of countries and central banks printing vast currency and the usury and the enforced on people without contract contract, and then the massive amount of money being taken from taxpayers to pay off the interest on the debt in most countries in the world, it is so enormously dangerous for any individual to have to deal with when it actually does come down. And people need to know that there are solutions. There are so many solutions out there, but people aren't looking at what should scare them. Because look, most YouTube channels that talk about these issues, I shouldn't say most, but a lot of them, they fearmonger, but they don't give solutions. They just get off on fear, which is what the government and the banks do. We want to, you guys should be scared, but we want to give you guys the solutions that put you at ease so that you can look at these solutions, in our opinion, and utilize them to protect your purchasing power, to save yourself against these crises that happen again and again and again because they repeat the same practices. And in some cases, like in the 2008 crisis, push it off further. It hurt people for a little while, and then they propped it up longer, and it's just a continuation of the same problem that was happening back then, but now on steroids. So there's so many issues that people can look at, but from our standpoint, in my opinion, people have to look at protecting their purchasing power, because purchasing power is getting wiped out, and you have to stop blindly depending on these investment schemes that bankers push on you at every bank at every turn. Zero down on this or that, this kind of loan, that kind of loan, a loan to pay off the loan on this loan and this loan. And it's never ending circular, and it is dependency at its worst, and it's the Hegelian dialectic of problem, reaction, solution, repeat. So I always go into this: food, water, shelter, self-defense. You're not gathering things for the toughest guy on the block, and of course gold and silver as wealth insurance. In my opinion, history says so. It's not an investment. It's not investment advice. It is simply our opinion, but look at history. It is meant as wealth insurance, protecting your purchasing power, not an investment anyway. If you want to invest in it, you become a bank like Deutsche Bank and you spoof markets and make money fast in a market that you really shouldn't be making massive amounts of money fast in. It's not about making more fiat. It's about growing your value or protecting your value for the long term. And then, of course, things like cryptocurrencies that are properly, fundamentally decentralized and useful, that aren't controlled by banks, that aren't pushed forward into this cashless society that we see that's centralized, centrally planned through the banking system. Cryptocurrencies that are truly decentralized outside of that system, that break apart, and blockchain infrastructure technology that can help replace the banking system and all these government programs that push people into servitude under the guise of free things and shiny things. So anyway, John, as we wrap this up, what do you have to say to Australians that are facing down this incredible storm that is on their doorstep?
Well, let's do a common education of economics here that you don't get taught from these bozos and idiots at the government that come in with socialist policies to fix poverty, is increasing all this stuff. Here's a economics lesson 101 for everybody out there. The monetary theorists, the Keynesians, stop printing money, and you won't have that massive wealth gap that they're creating, because the people on the top, they get 0% or close to 0%, and then they go and buy all the assets. Meanwhile, you have the poor people, they have to go out and get the credit card loans at 19-23%, and then the payday loans that 4 to 10,000% on an annual rate. So it's just an interest rate apartheid, and it's just mass amounts of printing of money that are creating all this wealth disturbance and wealth destruction, and the poor people in the world. It's not the ultra wealthy that they're talking about. It's actually the governments and the banks together that are creating poverty by printing all this currency. And if you look at I'm just going to show this one last chart. It's the M3 of Australia, just to show the Australians what the government have done together with the central bank and the bankers. Well, if you take a look at it, they almost printed about 90-something% more money since 2008, the financial crisis, to prop up the economy, to make people feel wealthy in the real estate sector, to create this false belief that people have money when they don't. They just lost a lot of value on their money. Their house is worth the same or less, and your house is not an asset. It's just a basic understanding, and it's just, when you print money, you create greater wealth inequality around the world, and that's just the basic economic reality here that nobody is understanding or seem to understand or talking about. And that is what I want to be the final word here, Josh.
Absolutely. So everyone, think for yourself, do some research, do your own due diligence, decentralize everything, rule yourself, be an individual, be responsible. Responsibility is a hallmark of freedom itself. We need to understand that if we want to move any further in our own lives, not to mention the lives of our families and protecting ourselves going forward, and learning from the lessons of history that repeat over and over and over again in different forms. Maybe history doesn't repeat, but it certainly does rhyme, and we need to be onto that and understand that to make a difference in our own futures and the lives of many others. So anyway, thanks for going into this with us, John, and until next time, this is Josh Sigurdson and John Sneisen signing out from World Alternative Media. Find the truth,
Be the change.
Like what you see here, OM, don't forget to check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so heavily demonetized and censored by YouTube, as these guys come in and flag all of our content as hate speech. The shadow banning is getting really bad, guys. Also, check our Bitcoin address right here on the screen or in the description below. We really appreciate it. And of course, check us out at the Red Pill Expo 2019. Of course, the great G. Edward Griffin and so many other incredible speakers will be there. Our link for that is below as well. And we cannot forget Mike Maloney's goldsilver.com, which you can also find in the description. One of the greatest market and monetary historians out there. We really encourage everyone to check that out. But until next time, this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
I'm sure you have already changed people's minds in your young age because you're involved, and I like that.
Bye.